Hi there, and welcome to another episode of Elephant Corner Financial Lab. My name is Nev Kraguljevic. I'm a financial planner, and in today's episode, we're going to talk about something really fun. Should I put my money into the savings account or the money market account within my brokerage, specifically in Treasuries? And today we're going to answer the $1 million question. Okay, it might not be $1 million question. Let's be honest over here. It's probably going to be like I don't know, a $50 question. But a question is a question and it should be answered. So let's do this. All right. So here is just to kind of put in a little bit of what we're going to be talking about. And this came in and working with one of the clients. We were talking about, you have money in your emergency account, right? And so we wanna keep that liquid. We wanna keep that safe, but we don't want it necessarily checking. And if it's a large amount of money, and checking is not doing anything. So we're thinking of like, let's put it into something that is generating at least some sort of return so that we're at least keeping pace with inflation, maybe beating it slightly so that money keeps working for us. Fair? Okay. So the question then came, should we do the savings account, high yield savings account, or money market treasuries? Now, this applies really in states that actually have state income. So for places like Texas or Nevada or even Florida, uh, this really doesn't matter because the state tax is not going to impact you at all. But in states where we have higher state taxes, think California, New York, and hello, Vermont, yes, it is actually going to matter quite a bit. So let's take a look at what are we dealing with. So let's assume a couple of things. Number one, we're going to have an income of $50,000 per year. We're going to assume single for the ease of math, and we have savings of about $12,000. That is our little emergency fund. Now, obviously, numbers are going to shift, brackets are going to change, but we're doing this for the ease of math, just to kind of understand the concept and the sort of the thinking behind it, so you can start making smarter financial decisions on your own. Now, here is what we have to work with. We have a high yield savings account that is giving us, let's say, 3.35%. And then we have money market treasury funds that give us, I don't know, 4.12 to 4.6. And this is, I used basically the most recent data as of end of October 2025. And of course, we want to account for fund fees because there are fund fees for these. So we're looking anywhere from like 3.8% to like 4.42%. And I used some of the most well-known money market treasury funds that give us this sort of differential that are with the largest brokerage houses. So things that you have likely heard of. Now, part of this is to understand the taxes. And when it comes to taxes, we basically have a few different things. So at $50,000 income, this is where the important part is because that's what tells us what is your marginal tax rate. And at $50,000 for federal tax, we're looking at 22%. In the state of Vermont, same income, we're looking at 6.6%. So not the highest we've seen, but also definitely not zero, right? Combined for Vermonters, we are looking at 28.6%. Now, I'm going to pause for just a second and answer a $1 million question. Why Vermont? Hello. I happen to live in Vermont. I am a proud Vermonter. I love the state. I love the people. And so that's why I'm running it with Vermont taxation. In your state, it's going to be different. And I work with clients all over the United States virtually. And so different taxation rules are going to apply in different states. All right, now that we answered that question, let's go on and tackle this income piece. So now we are dealing with income, right? So in the savings account, and right over here is where you'll actually see the savings account. So this right here is going to be savings account, and we're going to at $12,000, we're going to make about $402 per year. In our money market account, it's slightly higher interest, right? Reducing for the fund fees. And so we're looking at $453 per year. So about 50 bucks difference, right? And I did round up a little bit for this, just so you know. But here is where the key difference comes in, and that is on the tax. When we pay the tax from the savings account, the entire thing is taxed at both the federal and the state level, right? So after the tax from our savings account, we're left with $287 at the end of the year. So after the taxes are paid. When we talk about treasuries, those are taxed on a federal level, but not on a state level. And this is the part where I said, depending where you live, depending on your state, this may or may not even make a difference. But in state of Vermont, when we're looking at that 6.6% interest, then we are only going to deduct the federal, and we are going to be left with $354. So we're looking at $67 difference. So we saved a little bit. Now, I know what you're saying, right? But that's only 67 bucks a year. Like, is this even worth it? We ran these on really small savings account, right? So imagine what that would look like on, say, $100,000, right? Or $1 million. There's going to be big difference there. The second piece is we also ran this only if you were earning $50,000. But what if you were earning $250,000, or you were earning $500,000, right? The marginal tax brackets, both on the federal and the state, are actually going to go up, and savings are going to be bigger. Now, the other piece that people always ask is, well, safety and security. You don't have to put it in a money market. You can actually go to the government directly and buy treasuries directly if you want. If this is one of the ways to save funds. Now, one piece to keep in mind is you want to keep this as liquid as possible, because the point of emergency fund is to have it to the side so you're not using it daily, but also have it super easily accessible. So putting it in, like, 6 months or a year, locking it up, that's not really serving the purpose of emergency fund. That might be something else that you're saving for, and that's perfectly fine. But if we're talking emergency fund only, you want to keep it much more liquid, meaning I can access it within a day or two or three at the most, to be able to cover the unforeseen expenses, right? Unforeseen emergencies. That's what the purpose is. And really the point is that you can go directly there, and be able to save on taxes. And when it comes to safety and security, well, yes, the bank accounts, most people know, are FDIC insured. But FDIC insurance bases all of their stuff off of treasuries. So really, it's basically the same thing if you think about it. I hope this was helpful. I hope you have learned something brand new. I hope that this given you new things to think about and think through. And if you find yourself needing help, feel free to reach out. I am offering 30-minute free strategy sessions, and you will find the link in the description below. Until next time, stay money blessed.